Yesterday morning, gold traders were basically cheering a record high. I mean, the momentum looked totally unstoppable.
Oh, yeah. It was flying.
Right. And then just 3 hours later, $60 just, well, vanishes from the price of an ounce. It triggered this massive, just brutal sell-off.
It was a violent shift.
And the craziest part of all this, the catalyst that actually pulled the rug out from under the market wasn't, an escalation of war. It was a peace treaty.
Yeah, which always catches people off guard.
Exactly. So welcome to the deep dive. If you're holding positions right now and trying to figure out if you should be buying this dip or just bracing for impact, do us a favor, like this video, subscribe to the channel, and leave a comment below.
Definitely.
Today, we are tearing into the raw data from the June 16th, 2026 morning sessions to figure out exactly what drove this wild volatility. Joining us to break this all down is senior market analyst Michael Anderson. Okay, let's unpack this.
Thanks for having me. And to understand the sheer velocity of the price action we just saw, you really have to look straight past the raw numbers on the ticker.
Right, because $60 is just the symptom.
Exactly. The $60 drop isn't the real story. The actual story is this sudden collision of algorithmic trading, a massive geopolitical shift in the energy sector, and a bond market that is just fundamentally rewriting the rules of capital allocation right before our eyes.
Wow. Okay, let's start with the physical reality of the charts, though, because we need to understand the crime scene before we, profile the suspect.
That's a good way to put it.
Yeah, so yesterday morning, gold pushes up to $4,370 an ounce. Sentiment is overwhelmingly bullish.
Everyone was feeling great.
Right. Then, out of nowhere, we hit this massive air pocket. The price doesn't just decline, it liquidates. It drops all the way down for 4,310 in just a matter of hours.
Bypassing all the traditional support zones, yeah.
Exactly, completely blowing past them. Though this morning it managed to claw its way back to around 4,345. And silver saw the same initial shock, peaking at $71.30, dropping to $69.10, and then snapping back to $70.50.
Yeah, and look, it wasn't a free fall, even if it felt like one. It was a mechanical liquidation.
Mechanical, meaning the machines took over.
Precisely. When you look at the order books for gold around that 4370 level, it was incredibly top-heavy with leveraged long positions.
Ah, gotcha.
So once the price began to slip and cross just a few key moving averages, it triggered this absolute cascade of automated stop losses. The algorithms just take over, dumping contracts into a market where buyers have suddenly just stepped back.
Creating a massive liquidity vacuum.
Exactly. The price drops sharply until it hits that 4310 mark, which triggered a massive block of institutional buy orders. It's essentially a safety net woven entirely out of algorithms.
So we're seeing a market where the machines are just exacerbating the human panic.
That's the reality of trading today, yeah.
But zooming out to the technical structure, the intraday drama kind of masks the fact that we are actually still operating within an uptrend. The battle lines are just being redrawn, right?
Oh, that's right. It's technically just a correction.
Okay, so we're looking at fierce resistance now between 4,360 and 4,380, and then institutional support is solidifying between 4,320 and 4,330.
Yeah, and that 4,380 level is the critical ceiling right now.
Mm-hmm.
Until we break and close above that mark, there is no new trend confirmed.
We're just stuck in the mud.
Basically, yeah. We are stuck in a consolidation phase. The market experienced this rapid expansion, hit a psychological wall, and experienced really violent profit-taking. Now capital is just sitting on the sidelines waiting for a definitive signal.
Well, here is my pushback on the mechanics of that drop, though. You don't trigger a cascading algorithmic liquidation of that magnitude without a catalyst.
Fair point.
And the data points directly to the aggressive evaporation of safe haven demand. I mean, diplomatic channels are pricing in a 90% probability of a comprehensive peace agreement in the Middle East by June 19th.
Which is huge.
It is. But if that peace deal was already 90% priced in by Monday, why did the algorithmic sell-off wait until Tuesday morning to dump $60?
What's fascinating here is the lag between, diplomatic whispers and hard economic data.
Okay, walk me through that.
Well, it's one thing for the market to anticipate peace. It's another thing entirely for the energy sector to actually reprice global logistics. That June 19th timeline is critical because if that agreement is finalized, the Strait of Hormuz opens up to full unimpeded maritime traffic.
Which changes everything for shipping.
Everything. We are
Yeah.
talking about millions of barrels of oil per day suddenly stripped of their conflict risk premium.
Which perfectly explains the energy charts right now. I mean, Brent crude is sitting around $82.46 a barrel, and WTI is just hovering at 79.36.
Yeah, and that WTI number is the trigger. When WTI dips below that crucial $80 threshold, it sends a massive deflationary impulse directly into the trading algorithms.
So it's a chain reaction.
A very rigid sequence, yeah. Geopolitical tensions ease, which secures the shipping lanes, which drops the cost of Brent and WTI. And when oil drops, the foundational cost of manufacturing, transport, and agriculture drops globally.
And falling energy costs pull inflation expectations down right along with them.
Exactly. When the forward-looking models see inflation cooling down, the panic buying of gold, which is mostly used as a hedge against runaway inflation, well, it completely evaporates.
So the algorithms that track inflation expectations just sold their gold contracts the second WTI crossed below 80.
That was the trigger you were looking for. The fear premium just vanished.
Wow. Okay, so if peace brings global stability and lower inflation means fiat currency holds its purchasing power better, the immediate reaction is obvious: dump the safe haven asset.
That's the short-term reflex, yeah.
But that sets up a massive contradiction in the long-term outlook, doesn't it? Because we are seeing projections from our sources that this exact macroeconomic cooling will actually set gold up for a sustained sawtooth upward trend.
Yeah, a lot of people struggle with that concept.
Right, because how does losing your primary demand driver, which is fear, make the asset go up?
Because a market driven by panic is inherently fragile. I mean, when institutions buy gold solely because they fear a supply chain collapse or, hyperinflation, you get these parabolic spikes that inevitably crash.
Like a sugar rush.
Exactly like a sugar rush. But if inflation cools sustainably, central banks are given the runway to normalize monetary policy without forcing the economy into a recession.
It's a soft landing.
Right. And a stable environment shifts gold from being a crisis hedge to being a foundational portfolio diversifier.
So it transitions from a volatility play to a structural allocation.
You got it. And structural allocation moves slowly. It creates that sawtooth pattern you mentioned, higher highs and higher lows, climbing a wall of fundamental economic growth rather than riding a rocket of geopolitical anxiety.
That makes a lot of sense. But that cooling inflation environment is exactly what brings us to the elephant in the room here.
The heavyweights.
The heavyweights actively suppressing any breakout attempts. Gold isn't just reacting to peace in the Middle East, it is fighting a brutal, entrenched war against the US dollar and the bond market. Let's look at the metrics.
They're pretty staggering.
Yeah, the DXY, the US dollar index, is sitting aggressively high at 99.57, and the US 10-year bond yield is locked at just a staggering 4.467%.
And that 99.57 level on the DXY is doing enormous psychological and technical damage to gold's upside right now.
How so?
Well, whenever the dollar index approaches 100, algorithmic trading platforms treat it as a massive technical barrier. Because gold is priced in dollars globally, a dollar brushing up against 100 makes the metal prohibitively expensive for foreign central banks to accumulate.
Oh, right, because their local currencies are weaker in comparison.
Exactly. So they pull their bids, which removes a huge floor under the price of gold.
And then for domestic institutional funds, the problem is that 10-year yield at 4.467%. I mean, think about it from the listener's perspective.
It's an easy choice for a fund manager.
Right. Imagine you have a massive pension portfolio to manage. Your mandate is to generate yield while managing risk. You can put that capital into physical gold, which generates absolutely zero yield and actually costs you money to store and insure in a vault.
Which adds up quickly.
Yeah. Or you can buy a 10-year treasury note backed by the U.S. government, guaranteeing you nearly 4.5% annually just for sitting there.
And the spread between zero yield and 4.467% is simply too wide for institutional capital to ignore. The opportunity cost of holding gold right now is punishing.
Capital flows to where it's treated best.
Always. Right now, the bond market is offering a risk-free premium that physically drains liquidity out of the precious metals market. Every time gold tries to rally, fund managers use that higher price to liquidate their metals and reallocate into high-yielding debt. That is your ceiling.
Man. which means the entire precious metals market is essentially held hostage by the Federal Reserve right now.
100%.
We're seeing massive swaths of capital entirely sidelined today, just waiting for the upcoming Fed meeting. But the market has already priced in a rate hold, right? Nobody expects a cut this week. So what is the institutional capital actually waiting for before they deploy?
They are parsing the dot plot and the forward guidance.
Okay, so the tone.
Exactly. The rate decision itself is irrelevant today. What matters is whether the Fed acknowledges the cooling inflation driven by that $79 WTI crude, or if they maintain an aggressively hawkish posture to ensure inflation is truly dead.
So if Powell steps to the podium and delivers a hawkish narrative saying that services inflation is still sticky and rates need to remain restrictive through the end of the year, what happens to that 4.467% yield?
It solidifies, or it even pushes higher, maybe testing 4.6%. And if yields push higher, the algorithmic pressure on gold intensifies.
It just suffocates it.
Basically, a hawkish Fed essentially tells the market that the opportunity cost of holding zero-yield assets is going to remain high for the foreseeable future. That forces the technical algorithms to push their resistance lines even lower.
So we have gold caught in an absolute vice grip. It's losing its geopolitical fear premium to Middle East peace talks. It's being suffocated by a dollar pushing toward 100, and it's bleeding capital to a bond market offering 4.4%.
It sounds like a horrific environment for precious metals.
It really does. Yet there is a glaring anomaly sitting right in the middle of our sources today. While gold got absolutely hammered for $60, silver barely flinched.
Yeah, the divergence between the two metals over the last 24 hours is honestly the most telling signal in the entire market.
Silver's fluctuation range was incredibly tight, just $2.20. It dropped from $71.30 to $69.10 during the initial shock, but the recovery was super aggressive.
It snapped right back.
It bounced straight back to $70.50 and held the line. The data explicitly shows that speculative capital did not withdraw from silver the way it fled gold. Why is silver shaking off the exact same macroeconomic gravity that is crushing gold right now?
Because you're looking at an asset with a split personality.
Yeah.
Gold is a financial instrument, right? It lives and dies by real interest rates, currency strength, and safe haven demand.
Purely monetary.
Exactly. When the macro environment turns hostile to zero-yield assets, gold has nothing else to fall back on. Silver, however, is an industrial metal that just happens to trade on a precious metals exchange.
Ah, the industrial floor.
That's it. The paper market might want to sell silver because the 10-year yield is at 4.4%, but the physical market doesn't care about bond yields at all.
They just need the metal.
Right. The factories producing advanced electronics, the global rollout of massive solar farm infrastructure, the EV manufacturers, they physically consume silver. They cannot substitute it.
Yeah, I mean, you can't wire a solar panel with a treasury note.
You certainly cannot. And the procurement managers at these massive industrial conglomerates, they actively look for these macroeconomic dips.
Oh, so they are buying the dip.
Aggressively. When the algorithms drove silver down to 69.10, the industrial buyer stepped in and executed long-term forward contracts to lock in physical supply at a discount.
They don't care about the Fed's tone tomorrow.
Not at all. They care about meeting their manufacturing quotas for 2027.
Wow, that physical procurement acts as a massive shock absorber. While the financial traders are dumping paper contracts, the industrial side is aggressively taking physical delivery, which drains the available inventory and creates an incredibly stubborn price floor.
Silver is quite literally anchored to the real economy.
Which explains why silver's recovery back to $70.50 was so structural. It wasn't just short covering from day traders, it was baseline industrial demand soaking up the excess liquidity.
Exactly. And if you connect this to the bigger picture, it tells us that the underlying global economy is still running hot enough to support massive raw material consumption, regardless of the restrictive monetary policy.
Okay, so given this massive tug of war, you've got mechanical liquidations, peace treaties driving down oil, punishing bond yields, and this relentless industrial demand, how does an investor actually position themselves?
It's tricky.
If you're looking at your portfolio today, the short-term outlook looks like a minefield. The consensus across all our sources is clear. Day trading this environment is basically financial suicide.
Oh, absolutely. The short-term volatility we're seeing is specifically designed to hunt stop losses. With unconfirmed trends, conflicting data, and a highly anticipated Fed meeting looming, the probability of whipsaw action is just at its maximum.
So don't try to be a hero?
Please don't. If you're trying to guess whether the next $50 move in gold is up or down based on a 15-minute chart, you are just providing liquidity for institutional algorithms. You will get chopped up.
But the long game presents a radically different picture, right? Despite the immediate pressure from the dollar and yields, the institutional outlooks are calling this a multi-year accumulation phase.
Yes, the long-term outlook is actually incredibly bullish.
The baseline consensus is that gold is highly unlikely to break below $4,000 an ounce, and the macro trajectory is targeting a staggering $5,000 to $6,000 an ounce over the next several years.
And the mechanics supporting that $6,000 target are rooted in the inevitable turn of the credit cycle. Yes, the 10-year yield is high today. But sovereign debt levels globally are reaching a point where central banks simply cannot sustain these restrictive rates indefinitely.
Because they'd trigger systemic defaults.
Exactly. Yeah. Eventually, the Fed will have to pivot, not necessarily to fight a recession, but simply to manage the cost of servicing the national debt.
And when they pivot, the yield drops, the dollar weakens, and that massive pool of capital currently sitting in bonds floods right back into the gold vault.
That is the exact structural shift the long-term forecasts are modeling. Now, the downtrend pressure we are feeling right now could easily last another 3 to 6 months as the market digests the final stages of the Fed's policy.
It takes time.
It does. But the underlying foundation is building toward that $5,000 to $6,000 breakout.
So what does this all mean for you listening right now? If you're managing a portfolio, the strategy right now shifts entirely to risk management. You aren't trying to time the absolute bottom of this $60 drop.
No, that's impossible.
Right. You are using the volatility to build your position in stages. You accumulate slowly, maintain your physical holdings, and recognize that the current algorithmic chaos is really just noise masking a much larger macroeconomic cycle.
Exactly. Don't let a Tuesday morning liquidity vacuum shake you out of a 5-year thesis.
That is great advice. The most dangerous thing an investor can do right now is confuse a temporary liquidity event with a fundamental change in asset value. The gold you hold today is the exact same asset it was on Monday when it was trading at $43.70.
The only thing that changed is the paper pricing driven by algorithmic leverage.
All right, let's pull all these threads together. The violence on the charts yesterday wasn't random. It was a mechanical liquidation triggered by a sequence of massive macro events. We have a 90% probability of Middle East peace threatening to open the Strait of Hormuz, which drives WTI crude below $80.
Which drops inflation expectations.
Exactly, which strips gold of its fear premium and triggers the algorithmic sell-off. And simultaneously, gold is fighting a brutal war of attrition against a US dollar pushing 100 and a treasury note offering a 4.4% risk-free yield that is just draining institutional capital away.
All while the market holds its breath for the Fed.
Right. But amidst all that financial gravity, silver proves its resilience. Its dual identity as an industrial staple allowed manufacturers to buy the dip, creating a physical floor that completely insulated it from the macro panic.
It's a great setup for silver.
It really is. All of this data paints a picture of a treacherous short-term market, but a long-term landscape where gold is methodically building the foundation for a run towards $6,000.
Which leaves us with a fascinating, almost existential question about the future of these assets.
Oh, I like where this is going.
Well, we've established that the market is aggressively transitioning away from trading on geopolitical fear.
Right.
And is focusing entirely on central bank policy and inflation data.
Right. The fear premium is dying.
So consider this. What happens to gold's historical identity if global inflation actually is permanently tamed by these aggressive central bank policies? Wow. If the macro environment enters a prolonged period of low inflation and geopolitical stability, the traditional centuries-old reasons for hoarding gold as a crisis hedge just evaporate.
That's wild to think about.
Right. If it loses that fear premium permanently, will gold eventually be forced to rely on real-world industrial use cases, just like silver does today, to justify its valuation? What is gold actually worth in a perfectly stable world?
If the ultimate insurance policy is no longer needed because the house is fireproof, does the shiny metal still command a premium? That is an incredible concept to wrestle with as we watch these charts recalibrate.
Because there's plenty to watch, that's for sure.
Definitely. Thank you so much for joining us on this deep dive. As always, keep a close eye on that DXY, watch the tone of the Fed's forward guidance, and hey, don't forget to hit the like button, subscribe to the channel, and leave us a comment with your take on where gold is heading next. We'll see you on the next deep dive.